So for this mock exercise, we're going to take a look at a company called Newman Distributing Limited. We're going to look at a merchandising operation, transactions regarding this type of operations, and we're going to actually record a transaction, post it to T accounts, and prepare a partial financial statement. So let's take a look at this question. So this company's name is Newman, and they just completed the following transactions for the month of August. And the company uses perpetual inventory system to track their inventory. So what we're going to do is we're going to analyze each transaction, and we're going to actually post it directly to the T account as well. So on August 2nd, the merchandise on account, actually, before we do that, let's take a look at the required. So the first part of the requirement requires us to record a journal entry for the August transactions. Then part 2 says we need to prepare a T account and post the August transactions, calculating the ending balance. Now, the T account has opening balances because obviously we need to have beginning balances for the balance sheet account. So we've got cash $4,000, so we need to record it on our T account. Accounts receivable $5,000, common shares $5,000, and retained earnings $4,000. So this would have been the July 31st ending balances. Okay, so let's take a look at the first transaction. The first transaction said they purchased merchandise on account. So the word on account means it has to be a credit to accounts payable from KTL Supply for $8,900. And the credit terms is 1/15 net 30. And that means that if Newman pays the invoice owing to KTL within 15 days, they would get a 1% discount of the $8,900. It's called early payment discount. Otherwise, the invoice is due in 30 days. And it's called FOB shipping point. And FOB stands for free on board, and it's free on board at the shipping point. So when KTL puts the goods, the merchandise, at the shipping dock, and of course Newman brings their own truck, it is Newman's responsibility to manage and to engage a freight company to pick it up, whether it's their own truck or they pay somebody else to pick it up. So the shipment terms actually is extremely important because that will dictate who is responsible for the shipping cost. And two, it also is important because it allows KTL, the seller, to determine when to sell, when to recognize revenue. So if it's FOB shipping point, as soon as the goods leaves the warehouse of KTL, that's when KTL can recognize revenue. And from the buyer's perspective, from Newman's perspective, it would mean that they are now responsible for the goods in transit because they own those goods at the time of picking it up from KTL. So it is Newman's responsibility to pay for shipping charges, and it should be part of their ending inventory. So the first journal entry for August the 2nd is debit inventory. Because it's perpetual inventory, we're going to debit inventory, credit accounts payable for $8,900. Now, if I'm going to post it to the T account, I prepared a T account here, and I'm going to actually credit $8,900 on August the 2nd, and I'm going to debit merchandise inventory of $8,900. Okay, so this process, this is called a journal entry process. We're going to journalize the transaction, and we're going to post it to a T account. And this process is called posting to the T account or posting to the general ledger account. So think about this is the general ledger, and it accumulates all transactions related to inventory or all transactions related to accounts payable. So let's look at the second transaction. It says that the appropriate party paid $100 on August 2nd purchase. So we know that the appropriate party would have been Newman because it's FOB shipping point. So the fact that we talked about FOB shipping point means it is Newman's responsibility to pay for that shipping cost. Now we have to be mindful of this date too as well, because if we pay KTL within 15 days, we have to calculate the discount. So on August the 3rd, we need to record the shipping charge. And under perpetual inventory system, we're going to debit inventory, credit, in this case, cash, $100. And we're going to record that on our T account. So inventory, $100. Okay, and we're going to credit cash $100 here. And again, the reason why we're including it to inventory, because it's part of the cost of getting the inventory to Newman's place of business. So we need to capitalize all incidental costs related to inventory purchase to the inventory account. Now, obviously, if this was if we're using the periodic inventory system, then we would debit freight in or transportation in, which would be part of net purchases. So let's take a look at August the 6th. We sold 11,600 of merchandise to Kansas Supply Company on account. Again, on account means we're going to bill the customer and they're going to pay us, and we're going to give them a credit term, so pay us later. And the credit terms in this case is 110 net 30. Again, mindful of the date, because if they pay us within 10 days from August the 6th, we have to give Kansas Supply the 1% early payment discount. And this is called FOB destination. It means that the goods have to arrive in Kansas Supply before Newman can record the sale. Now, the cost of merchandise was $7,200. We need to know the cost because we're using perpetual inventory system. We have to record not just the revenue, but also the corresponding cost of goods sold. And it says the appropriate party paid $350 freight on the sale of merchandise. So who is responsible for the $350? In this case, because the shipping terms is FOB destination, free on board until the destination, that means that Newman is responsible for the shipping charges as part of selling cost. They're responsible to ensure that the goods arrive safely and in great condition to Kansas Supply's place of business. So there's a couple of transactions here. So on the 6th, we need to record the debit to accounts receivable. And this one is Kansas Supply. And that one is for $11,600. We're going to credit revenue or sales. We're going to assume that it did arrive on the 6th as well. Okay. Now we also, because it's a perpetual inventory system, we need to update the cost of goods sold. So debit cost of goods sold for the related cost of those merchandise. And we were told it was $7,200, and we're going to credit inventory. Now, in addition, we need to also record the expense of shipping charges. And in this case, we're going to debit freight out or transportation out. And this is a selling expense, not part of cost of goods sold. And that one there is for $100 or $350, sorry. And we're going to credit cash. So there were 3 transactions on August the 6th. And again, I'm going to post that on to the T account. So first, I'm going to debit sales, receivables from Kansas Supplies, $11,600 on August the 6th. Credit revenue or sales, $11,600. We're going to debit cost of goods sold, which is an expense, for $7,200. And we're going to credit inventory, $7,200, to reflect the goods leaving the merchandise inventory because it was sold. And I'm going to debit an expense. So this is a selling expense called freight out. And I'm going to credit cash. Okay? Now, moving on, let's look at August the 7th. Kansas Supply returned merchandise. So we sold them on the 6th. They returned some merchandise and was issued a $580 credit note. The merchandise originally cost $360 was returned to inventory. In other words, the Kansas returned a whole bunch of goods, and given the fact that they were returned to inventory meant that there wasn't damage, it was still in good condition, it was ready to be sold to another party. So here we need to reflect the actual sales return. So on August 7th, we're going to debit a contra account called Sales Returns and Allowance. That's a contra account to sales. And we're going to credit the accounts receivable, $580. And the reason why it's called a credit note is because the accounts receivables are normally a debit balance. If we're going to reduce the balance due to us, it means that Newman would have to issue a credit note. That's what it means. It's crediting an actual debit balance. That's why it's called a credit note. Okay? Now, in this case, because the inventory came back, we need to debit inventory for the original cost, and we're told was $360, and credit cost of goods sold. I'm going to short form that to C of GS. Okay? Now, we're going to update the T account again. So we're going to debit sales returns on the 7th, $580. We're going to credit accounts receivable, $580. And we're going to debit cost of goods sold, $360. And debit merchandise inventory and credit cost of goods sold, $360. So you can see from this video that the posting process is very tedious. The hard part really is the determination of the journal entry to reflect that business transaction. Now, number 10 on August the 10th, paid KTL. So KTL was balance of the balance owing. Now look at the date, the 10th. From the 2nd is only 8 days. And of course, we fall within the 15 days. Therefore, we have what we call a discount, an early payment discount. And that early payment discount is 1%. Okay? So let's take a look. On August the 10th, we need to calculate the discount. So first of all, we need to debit the accounts payable for the full amount, which in this case was $8,900. Now, the credit to cash will be less because of that discount. So we're going to credit early payment discount And because we're using perpetual inventory system, we're going to credit inventory. And that inventory is going to be $8,900 times 1% discount, which is $89. And then we're going to credit cash for the difference, which is 8811. So the idea behind here is that when we're in perpetual inventory system, any transactions incidental to the purchase, so such as, let's say, a return perhaps, or an early payment discount, or an allowance the supplier has given us on the pricing, that has to be adjusted to directly all to inventory, because that will allow us to determine the real net cost of getting that product into into Newman's place of business. But if we were to actually use the periodic inventory system, then the credit for $89 goes to another it's a contra account called purchases discount. So you'll see in previous videos that under the periodic inventory system, there are multiple contra accounts that reflects the adjustment to the purchased. And they get recorded separately for control purposes to track how much discounts, how much returns, and how much allowances has our vendors provided to us. But in this case, everything gets into inventory. So let's post the August 10th entry. So in the August 10th entry, we finally paid the payables, $8,900. So now we don't owe anyone because we only bought on April 2nd and we finally paid it on April the 10th. Okay, we're going to credit cash on April 10th for 8811, and we're going to credit the inventory for $89 on April 10th. Okay, so what's next? April 14th says we purchased merchandise for $6,100 cash. This time it's cash from ABC Company. So this one is we paid cash. So it's going to be debit. So it's August the 14th. It's going to be debit inventory. $6,100. Credit cash. And we're going to record that in our T account. So debit inventory on the 14th for $6,100 and credit cash $6,100. Okay? Now, what's next is August 15th. Received the balance owing from Kansas. So let's take a look at Kansas. We sold on the 6th, $11,600. They returned for $580 credit, and now we finally received payment. Now, the date is the 6th to the 15th. Do they qualify for the discount? The answer is it's less than 10 days, so the answer is yes, they qualify for the discount of 1%. So those are the things that you've got to ask when you see these transactions. So you've got to look at the dates to see whether they qualify for the discount or not. So on August 15th, we're going to credit accounts receivable because now they paid us. And the amount is $11,600, which was the August 6th balance, less the credit note issued on August the 7th. So that is $11,020. Now we need to calculate the discount. And the discount is a contra account to revenue called sales discounts. And that sales discount is $11,020 times 1%, which is $110. I just rounded it up. And that means that we need to debit cash for the net amount, which is $10,910. So here, I always start with what I do know. I always know that the amount of balance in our receivable needs to be eliminated because the customer has paid us. But that amount is not $11,600. It has to be net against the credit note, right? Then I proceeded to calculate the sales discount because they qualify within that 10-day period for a 1% early payment discount. That's $110. And then the net difference will be the cash amount that I would be expected to receive in mail. So that would be the 15th. I would credit $11,020. I would debit cash on the 15th, $10,910. And sales discount, I would debit $110. Okay, so let's look at the next transaction. On the 16th, I received a $500 refund from ABC for the merchandise that was returned. Remember, we bought $6,100 from ABC, and now we returned $500 worth of merchandise. So the entry there on the 16th of August is debit cash for $500 and credit inventory for $500. Because it's perpetual inventory system, we credit the inventory account. So let's update our T account here. So on the 16th, we've got cash of $500, and we're going to credit inventory of $500. Now, let's look at the 17th. 17th, we purchased merchandise for PMG for $4,200, term 110 net 30, FOB destination. So again, FOB destination, which means that it's free on board until the destination. So who actually is responsible for the freight charges? Well, if we look at the 20th, appropriate party paid $125 freight on August 17th purchase. In that case, who's responsible? If it's FOB destination, it would mean that PMG, who's the seller, would be responsible for all related costs of getting that sale or that inventory to the premises of Newman's place of business. So they are responsible for that shipping charge. Okay? Again, pay attention to the date because it says it's 110 net 30, which means that if we pay within 10 days, then we get the discount. So the entry for that one on the 17th is debit inventory, $4,200, credit, in this case it's purchased from PMG and presumably it's on account, so credit accounts payable, $4,200. And on the 20th, there'd be no entry because it is not Newman's responsibility to pay for that shipping charge. So let's post this entry. So on the 17th, we're going to record the debit to inventory $4,200, and we're going to credit accounts payable $4,200. Okay? Now, on the 21st, it says receive a $300 credit note for merchandise return from PMG. So we're going to reflect that return. So August 21st, we're going to debit accounts payable because we returned, so we no longer owe it, and credit inventory. Again, let's post that. So on the 21st, we're going to credit $300 in inventory and debit accounts payable $300. Now, what happened on the 23rd? It says sold merchandise for $6,400 cash. The cost was $5,200. Again, we need to record the sale. In this case, it's for cash, so we need to record a cash sale. So debit cash, credit revenue or sales for $6,400. And remember, because this is a perpetual inventory system, we need to reflect the cost of goods sold immediately at each stage of the sale. So we're going to debit cost of goods sold for the related cost, which is $5,200, and credit inventory $5,200. So let's post that entry. So first, we want to debit cash $6,400 on the 23rd and credit sales of $6,400. We only had 2 sales this month, right? And then we're going to debit cost of goods sold for the related costs and credit inventory on the 23rd. Now, what happened on the 27th? It says paid PMG distributors for the balance owing. So let's go back again. We bought on the 17th $4,200 worth of goods, 1% discount paid within 10 days, and clearly that's within 10 days, just right on the 10th day. So we qualify for the discount. And we also got a credit note because we returned something. So we need to offset and net that, right? So let's do this final entry on the 27th of August. So first, we're going to debit accounts payable because we no longer owe it. And that would be the $4,200 less the $300, $3,900. Now, we need to calculate the discount. So we're going to credit inventory for the discount. That would be $3,900 times the 1%, which is $39. And that will allow us to calculate the amount of cash paid. And that would be the difference between these two is $38.61. So that's the journal entry on August the 27th. So let's record that. Let's post that onto the T account. So first, we're going to debit accounts payable, $3,900. Then we're going to credit inventory because we sold it. And we sold it when we got a discount, $39. And the cash is a credit of $38.61. Now, we're going to need to add, and we need to summarize the T account. So in summarizing the T account, here's what we need to do. We need to add all the debits and credits, all the related debits, starting with the opening balance, add all the debits and subtract all the credits. And then we realize that we've got a net debit of $25.88 for the April 30th balance for cash. Accounts receivable, you'll see that we've got $5,000 plus $11,600 minus these two, we end up with a net balance of $5,000. Inventory, you'll see my adds of debits and credits, and the remaining balance, debit exceeds credit by $6,332. So these are the ending balances. Now, common shares, there was a $5,000 opening balance. There were no transactions, so $5,000 remains as the, this should say August, by the way, not April, August. Okay? Now, Accounts payable, you'll see that the net of that one is 0 because we finally paid it. Revenue, you'll see that's 18,000. That's my total revenue. Sales return is 580. Sales discount is 110. Freight out is 350. These are my ending balances. And my cost of goods sold is 12,040. And my retained earnings balance was 4,000 beginning. It will 4,000 at the end. But remember, we're going to update the retained earnings after we close out our statement of earnings or income statement into retained earnings. So that's what happens at each month end. We need to close out the account. So let's do an income statement because that was the next question. So the income statement. So we've got Newman Distributing Limited income statement, or if you like, statement of earnings. And the date is for the month ended August 30th, 2013. First, we're going to start with sales. And we saw that the remaining T account balance was 18,000. And we have two contra accounts. So sales less sales returns and allowance. And sales discount. That gives us 17,310. That's called net sales. Then we've got cost of goods sold. Is 12,040. To give us a gross profit of 5,270. The question only asks us to do, for part 3, it asks us to do a partial income statement, presumably up to the gross profit. But remember, we have to subtract the selling expenses as well, right? But we're not going to do that here. We're just going to stop at gross profit. That's number 3. And number 4, it's asking us for the current asset. So Newman Distributing Limited, partial balance sheet, for the it should say as at actually. It's at August 30th, 2013, because it's a point in time statement. And they only want current asset. So first we have cash, 2,588. We have accounts receivable, 5,000. These are from the ending balance of the T account. And we've got inventory for 6,332. That's my total current asset. Okay, thank you.